Picking which shares to buy on the stock market is a complicated and confusing process that only a very few experts know how to do. It's not something that everyday people should even consider doing. Well, that's what the experts on Wall Street want you to believe. In reality, choosing which shares to invest and making a profit isn't rocket science. However, it does take some learning and practice. As a beginner investor, your best bet is to invest in shares of a few companies that are stable and secure, and you would be comfortable holding for some time. Do not make the mistake of buying into companies that are on the riskier side, at least until you have gained some experience investing. After all, you don't want to lose faith in the market and all your money on the first go. In this video, I want to take you through some key, basic steps to follow when choosing which company's shares to invest in, as well as some fundamental investment ratios to analyze. Let's dive in. Number 1. Investment value. The first and most important step is deciding how much of your capital you're able to and willing to invest in stocks. As a beginner investor, I would suggest investing around 20 to 30% of your wealth, at least until you start gaining some experience. The key here is to only invest money that you know for sure you won't need at least for a few months. Investing takes time, patience, and learning. Having to sell your stocks at a bad moment just because you're strapped for cash is definitely not the way to go. Number 2. Investment goals. Once you know how much you're willing to invest, I would suggest that you then take the time to decide what your investment goals are. Two main goals of investing in the stock market are capital appreciation and dividend return. Let me explain. Capital appreciation is the profit you make when the shares you hold increase in price. For example, if you buy a share at $10 and sell it at $12, you have just made a capital appreciation of 20%. Dividend return is the return you make on the shares you hold based on the potential dividend a specific company pays out. Simply put, dividends are payments companies make to its shareholders from the profit it makes. For example, if you receive a dividend of $1 from a share you bought for $10, you just made a dividend return of 10%. Different companies pay out dividends in different time periods. Some pay yearly while some pay quarterly. How you spread out your portfolio of shares based on these two objectives is completely up to you. You could put 50% of your investment in growth companies that would give you capital appreciation and the other 50% in high dividend paying companies so that you get a cash payout on your investment. Number 3. Which industry? Once you've decided how much you want to invest and your investment goals, I would suggest that you pick a good industry to invest in. Researching which industries are doing well or has the potential to do well is not complicated, and most often just needs a bit of common sense. The time at which you invest is also an important consideration here. For example, when investing during a pandemic season, industries like the pharmaceutical industry and goods and services are likely to do much better than the travel and hospitality industries. You can also stand to gain a lot by taking the time to invest in lesser known or new industries that have the potential to explode in the future. Number 4. Which companies? Once you've decided which industry you want to invest in, the next step is to make a list of companies that operate in these industries. This information you can find easily on Google or on your country's stock market websites. Number 5. Analysis. Now we get to the fun part. Analyzing the companies you chose and picking which company stocks to buy. Here are a few simple but useful factors that you can consider when doing this. Revenue. Has the company's revenue kept growing or stayed stable over the last few years? This is a good company to shortlist. If you notice that the company's revenue has been shrinking, you're better off crossing it off your list. Earnings. Has the company been making profits? While high revenue is a good indicator, it doesn't mean much to its shareholders if the company isn't making profits. Companies that haven't been making steady profits and have no chance of making profits in the future should be crossed off as well. Dividends. If your investment goal is to make a dividend return, check how much of dividends the company pays out each quarter. Most companies have a consistent dividend policy where they pay a certain percentage of the company's earnings per share. Say for example, a company with an earnings of $10 per share historically pays out 50% of its earnings as dividends to shareholders. That would mean you get $5 for every share you own. This is what we call dividend per share. Another important factor to consider is the dividends per share in comparison to its market price. This is what is known as a dividend yield. Say for example, you paid $20 for a share of a company that pays out a dividend of $5 per share. Your dividend yield would be 25%. You can compare this to how much of a return you would make with a fixed deposit. For example, if the fixed deposit interest rate is 10% in your country, you're much better off investing in a company with a higher dividend yield. All of this information is readily available to investors in the company's annual reports, so you have no excuse not to do your homework. Number 6. Price. Last but not least, you need to make sure you're paying the correct price for the share. When it comes to the stock market, price is everything. Most beginner investors think that the higher the share price, the better the company. This is wrong. The share price should always be compared to the company's earnings. A high share price for a company with low earnings is an indicator that the share is valued incorrectly and is therefore overpriced. But how do we know if a share is overpriced or underpriced? We do this by looking at something called the price to earnings ratio. The price to earnings ratio of a share is calculated by dividing the price of the share by the annual earnings per share. This allows us to compare various shares to each other or the same shares against its past performance. Let me give you an example using two of Australia's largest supermarket chains, Coles and Woolworths. Let's assume that a share of Coles is trading at $10 and its earnings per share or EPS is $2 per share. This simply means that shareholders are paying 5 times the earnings of Coles to become a shareholder. The price to earnings ratio is 5. Woolworths, on the other hand, has the same market price of $10 per share, but its earnings are $5 per share. This means shareholders are only paying 2 times the company earnings to become a shareholder. In other words, the Woolworths price to earnings ratio is 2. Buying a share isn't really different from any other purchase you make. You always want to make a good deal. This means paying as less as possible for the most value. So, with this logic in mind, which share do you think is priced cheaper for us to buy? Correct. That would be Woolworths. Let me simplify this even more for you. Let's assume that Coles and Woolworths both pay their total earnings as dividends to its shareholders. In this example, investing $10 in Coles, the price of a single share, would give you a dividends of $2, while investing $10 in Woolworths would give you a dividends of $5. Picking Woolworths in this case is a no-brainer, isn't it? By analyzing various companies' price to earnings ratios in this way, we can decide if a share is overpriced or underpriced. Simply put, if a share is cheap or if it's expensive. Alright guys, so I've tried my best to go through the key basic aspects you need to consider when picking shares to invest in, and I've tried to make it as simple as possible. So I hope this video has been helpful. If you like this sort of content, please take a minute to give this video a thumbs up and subscribe to my channel. Go a long way in helping me build my audience and making more videos like this. I'll see you soon. Stay safe.